We have a question here from Sergey saying that he saw a headline on a Bloomberg article talking about the recent rise in gold prices, and the headline alluded to the S&P and gold ratio, and he just wants a little bit more information about it. So, uh, looking at this chart, if you have trading views, Sergey, by the way, you can set up your own S&P to gold ratio chart by using this code. So just type in SPX /GC1 exclamation mark. And if you press enter, that should give you the blue one. So to just explain this a bit better, I just overlaid gold also for us here in orange on top of this chart. So generally speaking, the ratio is simply comparing the value of the S&P 500 to the value of gold. And you can basically do this with any instrument like silver or oil, etc. And the idea here is that the higher the ratio goes, the more expensive, obviously, the S&P becomes relative to the price of gold. And that would normally be indicative of a risk-on environment or an outperformance in stock environment, an environment where investors will pile money into risk assets and prefer risk assets over and above something like safe havens, like gold and bonds. And of course, vice versa, when we see a strong move lower, it means that the price of gold is getting more expensive relative to the price of something like the S&P, and that will normally be indicative of something like a risk-off environment where investors want to protect their portfolios by preferring safer investments like gold and bonds compared to something like equities. Now, if we compare this with the timelines of the big bubbles and recessions, it does make sense. So if we look at that early 80s running into the dot-com bubble, the ratio was at its highest where stocks outperformed anything else. And going into the first massive recession of 2000, and of course going into the global financial crisis from 2007, we saw the ratio completely reverse as investors sought safe havens to store their wealth, such as gold, etc. Also, gold seen as an inflation hedge, which is important here because that saw the ratio further move to the downside, where fears of inflation started to creep in from 2009, where central banks stepped in with quantitative easing. And that brought about fears of lots of inflation and, of course, brought financial repression as well, which saw gold gain a lot more attraction from investors. So the idea behind the article that you cite is that the recent jump that we've had in in gold prices, even though we shot up above historical highs, even though it was an impressive run to the upside, it barely moved the needle of the ratio itself. And the reason for that is even though gold had a major run to the upside, equities have also performed very, very well from mid March. And we all know the reason for that recent run has been the massive, unprecedented support from the Fed. With QE, the amount of QE seeing right now is unlike anything we've ever seen. And that has supported both gold as well as equities. Now, the statement assumes, though, that the double performance between stocks and gold remains in place. So, meaning that gold and equities continue to grind higher alongside each other in relative pace. Now, if we just take a look at history, that would suggest that the assumption could be proven wrong, as some analysts are calling for gold to go as high as 3,000, some as high as 5,000 even, quite easily if we see markets following the same type of trajectory for growth for something like gold going from 2009 to 2011. Now, the thing that we need to be careful of here is that that also assumes that investors will behave the exact same way as they did towards inflation and QE as they did back in 2009. And also reacting the same way to stocks. So think about it for a second, right? That assumes, if you assume that gold prices are going to 3,000, I'm not saying it's not going there. I'm just playing the devil's advocate here, saying that that assumes that investors will have the same fears about inflation as they did back in 2009, which might not be the case, right? So everybody feared inflation from 2009, 2011, all the way, to the tapering started, and we never really got inflation back. So that assumes that investors will use gold as a inflation hedge, as they did back from 2011, 2000, and from 2009 to 2011, which might not be the case. And it also assumes that the Fed leaves QE on the table for the next 5 to 7 years. Now, given the sheer size of the current stimulus that we've had, the massive bond buying we've seen, not only from the Fed, but from around the world, there is a chance that we might recover a lot quicker this time around after going through a mess like this already, going back to the global financial crisis. It might mean that we might not have or need the same type of stimulus for as long as we've had, or for as long as we had back in the global financial crisis. We might come out of this a lot stronger, a lot sooner, which means that we might have a lot less momentum to the upside for gold if QE can be tapered quicker. So there's a lot of assumptions, obviously, on both ends of the spectrum, but that is the general ideas of the article, is that the move in gold hasn't really had the same type of impact as you would expect, because equities also performed quite well. So all in all, I can see why investors would look at this chart, from a risk barometer point of view, but from a trading perspective, especially from an intraday and intra-week perspective, it's not really something that I look at all. Really, it's not really something that I would base any trades on, if that makes sense. So I hope that helps with the explanation, Sergey. Any other questions, as always, please don't hesitate to let us know.